Okay, hello and welcome everyone. I'm thrilled to introduce our esteemed guest today and our newest member of the panel of partners at Hotspotting, Mr. Lucky Velasquez of Finance Better. With over 15 years of experience as a mortgage broker and a long career with the major banks, Lucky brings a wealth of knowledge, insights and strategies to our Hotspotting community. Our webinar today is entitled Navigating the Mortgage Market in 2024, and we'll aim to run for about 45 minutes, leaving about 15 minutes for the Q&A. So be sure to get your questions into the Q&A box, and we'll endeavour to get through as many of those questions as we can. But today, what Lucky's going to be taking us through is a bit of a presentation to talk about the state of the current mortgage market and what sort of impact, the latest changes have had on borrowers. He's also going to talk about some of the predictions and trends to expect in 2024. And then he'll also discuss his specialty, which is assisting self-employed clients and people with self-managed super funds. So Lucky, absolutely loving having you on the panel today. And as you know, we put you through your paces. We were very...
you did.
It's very strategic who we invite to the panel of partners members. And as you know, it's an invitation only thing, but you stood out to us. There's a hell of a lot to like about your experience and the way that you go about your business. As a mortgage broker myself, I really appreciate the way you go about it. And I think you brought some innovation to an industry which has been quite slow to pick up their act for the last couple of decades, to be honest. But exactly. You guys do it very well, so welcome.
Thank you so much. Yeah, and Tim, you did put us in our paces, and we appreciate you actually. So it just makes this relationship smoother, and we feel very delighted to be part of the Hotspotting community.
Very good. So we'll kick things off with a bit of lighthearted stuff, Lucky. Obviously, we're introducing you to our Hotspotting members today. So first of all, I want to know where did the name Lucky come from?
My mum had a pretty rough pregnancy. I got a massive head actually. So and obviously being Asian and bald and all that stuff, and the associated with Lucky just came. I was born at the 8th of October. And yeah, it literally was just followed me all the way through. But yeah, so lucky by name, lucky by nature, hopefully.
Very good. And you've lived your life that way as well.
Yeah, I've been pretty blessed. Absolutely. Good family, good friends, good relationships. So yeah, like my name should be blessed, but if you want to call it lucky, then yeah, there's a lot of luck there. But yeah, that's my background, my man.
Okay, so now I know you're going to talk a little bit about your business as we go through, but high level, you have a couple of different companies. Tell us a little bit about your businesses.
Yeah, so we've got Finance Better, which is a mortgage broking firm, and we do a lot of complex stuff. To be honest with you, we do a lot of deals from other lenders who can't assist, as well as help with kind of some brokers with the more complex scenarios. We do that. We've got a property group called Property Avenue. That's a buyer's agency, and we're very, very in touch with that. The Finance Better business has been focusing a lot on investors and the more complex files, and Property Avenue was just an overview of that. And then we do have a couple of interest in accounting firms and other bits and pieces. So well-rounded conversation to have. But again, my focus is definitely just the finance component. I think that's where I'm good at. Yeah. And I'm going to focus on that, my man.
You like to stay in your lane. So
I do.
Obviously, as I mentioned before, I found that the broker industry hadn't changed a lot in their practices for a long time. And what I liked about Finance Better, you're a coder yourself, and you've brought some innovation into the broking space, which I really like. I mean, I've always had an issue with the fact that we're still in 2024 sending emails with, our ID and pay slips and, fact finds and things like that all over email. And you brought some innovation, which will allow people to do this type of thing in a secure environment online.
Of course. Yeah, look, what we really try to do is really push innovation. My background, I dabble in coding, so we understand what tech background looks like. There's a couple of joint ventures that we do with, with a couple of tech firms. And guys, apologies, I have been sick for the last 6 weeks. So in case I cough, in case I'm drinking, I apologize for that. But there'll be a little grunts here and there. And apologies.
You'll be fine.
But no, it'll be fine. So the Hotspotting community has been very good to me. So yeah, I was just saying, yeah, look, I think the broking needs innovation. I think it's a very old school. I think the way that we train is still very dated. I think that a lot of banks and brokers put this facade that there is tech at the front, but really It's just a manual back end, and I think that needs to change. So we are in conversations with some high level tech firms and potentially doing some joint ventures around AI and how to kind of smooth line that burning relationship to make things a bit more easier for client journey. I don't think it's just the approval now. I think the client journey needs to be taken account outside of obviously getting
Well,
things just
it's security, it's transparency,
yeah.
it's understanding what's next and timeframes. And I feel like there's a really big innovation piece that you can bring in. I've seen the sort of work that you guys are doing there, and I'm excited for our our audience to see it as well.
Yeah, I'm
Now I
excited
know
too.
you've got a presentation that you're going to take us through today. So rather than me throwing a million questions at you, if you want to share screen, you can kick things off.
Absolutely. Well, let's share screen and then yeah, look, let's go through it. So guys, if you guys can't see, you can see my screen here, Tim.
Yeah, we've got you.
Fantastic. Well, look, guys, I will try to be as quick as possible, but as thorough. And I'm just going to show you effectively what is happening in the marketplace at the moment with mortgages. I'll kind of go into deeper versions in terms of what we see, right? Because sometimes news is one thing, but we work inside, so we're in the trenches. I'll tell you all that stuff, and I'm not going to hold any bars. So apologies if I do swear a little bit. I am rough around the edges, and I'll try my best to not do that today. This is a little rating that we've got here. Obviously, disclaimer. It's just today's educational presentation. Opinion, not advice. Obviously, seek a personal financial tax and legal advice prior to acting any information here. So just around here, and again, PG rating there. If you got kids around, it's the ideal situation to put me there. And there's our licenses at the bottom there. But the goal today is this: is if you currently have equity in your home, what do you do with it? Misconceptions around bank practices. I think the narrative around banking practices, we need to talk about that. Your relationship with money, and just for you to realize there's actually better out there. I think that's really important. And again, look, my name, people call me the Malteser because I look like one. But again, this is me, and just some accolades. I'm super opinionated with opinion. It's got me in trouble sometimes, but we're migrants here. This is where I'm from. So my background's actually Filipino. I've come from the slums of Tondo, so it's a very, very rough area in the Philippines. If you got any Filipino friends, say, have you heard of a place called Tondo? And they would be like, how did someone get out there? So pretty rough area, and obviously coming here as migrants, there's a lot of financial literacy that we didn't understand. And I was motivated to change that in a way that I could understand it, in a way that we could break it down from that. And I think that's really important, especially talking about finances and broking when there's so much random jumbo that a lot of people don't really understand. I just want to take back and be like, this is where I'm from, and yeah, just kind of take you a snippet into my life. If you don't know, obviously that's me, a little cute boy with the green hat. That's myself. I had hair back then, but all good. And now let's go here. The first question is, how's your money head? Before we start this, the biggest thing regarding talking about any policies or any bank practices is just how's your money head? How's your relationship with money? And you think you're successful with that? Is your money head there? Are you fearful of the marketplace? Are you not fearful of the marketplace? Like, where are you kind of sitting at the moment? So hopefully in the next 40 minutes, I do want to talk as friends here, or else I'd have a beer or a wine, but it's not the time for it because I've got this cough. But I do want to talk as mates. I do want to talk as friends. I just want there to be open conversation regarding it. I think that's the best way to kind of start this relationship together, and obviously this webinar together. Again, if you want to achieve success, I love this quote. Find a way to model those who have already succeeded, and that's probably one of the main reasons. I should have put Tim there, to be honest, versus Tony Robbins. But we joined Tim and Hotspotting because we see the successes that as Tim has also done and the group has done for the last couple of years. We've been following that journey, and we wanted to be impactful in that. And we've helped hundreds, if not thousands, of people find success. And obviously, with the relationship with Hotspotting, hopefully we could do that for everyone that's here too.
I think just
Now
on that
let's
as well, I
tell me,
know
my man.
we've discussed this in the past, but mortgage brokers typically go and find you a better rate. right? And typically resetting in a 30-year loan. And, there's a huge difference between a good broker and a bad broker, in my opinion. And I think one of the things I really like about Finance Better is that you understand structure and policy. It's not just about rates. You take into account what your customers' goals are and say, listen, we're not going over here with the best rate. In order for you to achieve the goals that you're trying to achieve, this is the type of structure we need. And the fact that you can help, we have a lot of self-employed clients and sole traders, and
Of
the
course.
fact that you guys specialize in that, I think, is going to bring a lot of value to our customers.
Yeah, and you're right. Like, especially growing in the investment space, the goal for us has never been just about interest rate. Interest rates is one thing, and that's great. To an extent, you need to understand what that looks like. But if you're not versed in policy, there's actually no point talking, right? And that's the big thing. And this slide is perfect for that. CBA, WBC, NAB, ANZ. I love these guys. I think they're great, big four, but I show this because I'm just like, this is what probably you feel, right? Where they are pushing the narrative. Big four shouldn't be pushing the narrative anymore. There's so much more non-bank lenders out there, especially if you are in that self-employed or investor marketplace where you're trying to grow wealth and trying to understand what that looks like. That there's something better, right? And I just use this as an example because growing up as a migrant as well, there was only these four banks that we were like, that's who we need to go to for owner occupied and investment and everything else. Whereas now the landscape has obviously changed.
Yeah.
So I am going to go through the following, which is the current state of the mortgage market, impacting its borrowers, prediction and trends, best practices. That's probably a good one. And I'll talk about point 3 and point 4 in a very intimate way. I'll talk about what we talk to credit about, real insights on that information.
Yeah.
So let's talk about the current state of the mortgage market now, impact the borrowers. So obviously we've seen the last 2 years be aggressive on that rate rise. We are seeing that mortgage stress kind of peak, right? But who's the mortgage stress peaking with? And again, let's kind of dive into what I'm talking about, real life scenarios here. The number of Australians that we're kind of seeing peak in that mortgage stress is actually non-investors. What we're seeing actually is owner-occupiers. Owner-occupiers are starting to feel that pinch. And the reasoning why is when you have an owner-occupied home or a PPOR, principal place of residence, it's only two incomes. It's like, or one income, or the owner of that home, that's it. You've got to take care of your expenses as well as your liabilities. There's no other income coming through. And this is why there's a feeling of mortgage stress happening at the moment. So yeah, you can see here 29 out of 100 borrowers were in mortgage stress kind of mid-year last year. And again, we're seeing that it was I think more publicized kind of towards mid-year to early last year. And it's funny because 2023 we've kind of just accepted the fact that was the rates. Obviously, media is an interesting beast in itself. Now, do we see this in real life, scenarios? The answer to that is yes. We do see this in real life scenarios when we talk to clients. But again, who we see it from predominantly is actually owner occupiers.
I don't think that's surprising either, given that, as an owner occupier, you don't have any, tenants helping contribute to that mortgage repayment. As an investor, when I'm paying a mortgage, if the rates go up, I'm still claiming that interest at the end of the year. And on the other side of that is we've also had extremely high rental growth. So I echo the fact that we're probably not seeing that much mortgage stress with investors.
Yeah, and just going back to the whole owner occupier, you're talking about rental, yes, to an extent you ask for increases, but let's be real straight with each other. It's not like you can go to an employer and be like, hey man, or hey girl, give me another 50 grand. That would make my life easier, right? And the best way it's just not going to happen. Expenses for the most part is most likely fixed, right? And that conversation regarding that is a big one to have. So again, we're seeing a lot more arrears happening. And again, owner occupiers, usually higher LVRs, usually higher debts. Statistically, owner occupiers do have higher debts than investors. We are seeing the number of households kind of falling behind on their mortgages, owner occupied mortgages. And again, 30% of their disposable income going towards that towards the end of the year. Now, market dynamics for impact of investors. This is important. Now, this is a very interesting slide. Very interesting slide to note, right? And again, we're talking about what the media is portraying. And I want to go through the next couple of slides how this is, I want to say bull sheep. I'm not going to say the word, I'm going to say bull and sheep. That's it. So decline in investment activity. If you look at the micro timelines being 22 and 23, that's a fairly small gap, right? So we're peaking at investor loans 21,663. We're seeing a 42% decrease in new property investment loans. Now, this is interesting. You may go, oh, okay, so there's no investors, like we shouldn't be investing, what's to go? What we're actually seeing is a lot of investors change their strategy for investing. They may have already had capital growth, and what they're trying to do is offload that security and then pausing a little bit, using any capital growth on that to then look at potentially higher yielding, kind of more affordable securities. Yeah. And then we're starting to see a bit more debt recycling. So what the media may portraying is, yes, there's a drop on investors, no investors, yada, yada, yada. It's a terrible time to invest. But real investors, and what we're seeing for even our clients now in the groups that we help, is people are offloading their investment properties because they made the money.
Yeah,
right?
no, 100%. They've seen that they've hit a peak in the market. COVID boom. They're like, well, I could knock over one of my investment properties, wipe out the debt on that, and with the balance, and take a huge chunk off my owner occupier, which is going to reduce my repayments, increase my borrowing capacity, and I can reinvest into another location, which is at the start of a rising market again.
Perfect. And to that, so they'll park it in offset. They'll be like, okay, cool. Where's a rising market? Like the next couple of slides will just show you that it's not uniform. Like the performance in New South Wales isn't the performance in WA. And inside, say, New South Wales or WA or those states, for example, like I'm just using those two sets as an example, you still have microeconomies inside there. One suburb is going to perform differently to another suburb, so on and so forth. So whilst the market is saying, or the news is saying 22, 23, the decrease of investors, what's really happening towards it and why we're seeing a decrease? And obviously we are seeing a massive demand in that, high, low unemployment rates. We're seeing high migrants come through. Probably the most we've seen in the last couple of years has been insane. And we're not building as quickly as we do. The council state is not pushing for approvals as quickly as we would like to. A lot of red tape, and that's been super hard moving forward. Now, this is an interesting statistic. So 2019, 27.9% has been the portion for investors. I said before, 2 slides before, there was, if you look at just a couple of months, we're seeing a decline. However, as an overall trend, we're actually seeing the investor market really strong. So now close towards December 2023, from 2019, we're actually 35.5%. So we're actually trending higher towards investors, whereas the media would say investors offloading, they're not doing well, yada, yada, yada. It's actually incorrect.
I think it's interesting to look at that per state as well. I know we've seen a lot more investors selling in the Victorian market as an example with
oh man, perfect.
Yeah, I mean, we're obviously making it pretty difficult for people to want to invest in this state, unfortunately, down here in Victoria, because they're throwing taxes at any opportunity they can for a cash grab. So I'm not surprised to see a lot of people selling up in Victoria.
Yeah, exactly. And then same thing, that it's not like they wanted to sell. It's investment. You don't have to hold an investment forever. You use the investment to work to your advantage up until it serves a purpose. And if it doesn't, you recycle and reinvest somewhere else. So investing 101. So again, we're seeing November 23, new home investment property up by 13.1%. We're seeing a massive growth. It's on the ABS. You guys can search it as well. This is the average loan size for owner occupiers, so 624,000. That is the average. I know some people have higher or lower mortgages, but we're seeing the average towards there, which is a small increase on the national level. And then we are seeing this now for investors. So the average of investor is around about 573,000 approx for it. Obviously, if you got investments in SA or WA, that could be a little bit smaller, but we're just seeing that as an average, then do so. And again, it's interesting to know that invested loans do play a significant role in the real estate market. We all know this. I think we need more people to invest in property, because where are people going to stay? There's been instances of groups of families living in 2 or 3 bedroom houses, 2 or 3 bedroom apartments, just to get by, to save some money, just so they could buy their own. This is just some random stats, just so you guys could see what that looks like. A new home and investment surged 13.1 year on year on November. Again, positive result. We're seeing investor loan commitments now rising to 18%. So again, how is the strength in the market is great for investors, even though the media has portrayed something else. And obviously highest rates just affecting financing across the property market for servicing.
So obviously, with
And
just on the subject of those higher rates, obviously the big impact there outside of affordability is actually borrowing capacity, Lucky.
mhm.
How have you seen that, over the last 12 months? How much of an effect has that had on most of your customers?
Borrowing capacity is a massive one, to be honest with you. And this, like I wrote this slide specifically, it's not uniform,
Hmm.
right? Like what the RBA does versus servicing calculators is completely different. We're at 4.25, 4.35, whatever it is, and what we're seeing is basically this disjoint of what the lenders are doing. The servicing calculators are intense, and even for lending, like you know, some lenders are only taking 70% of the rental income and shading it because of policy that they didn't know can go somewhere else, take 100%, plus negative gearing, etc., etc. So there's actually quite a lot of things here that's not uniform. To answer your question, I don't think servicing is an issue. It's gonna be let's go controversial.
Yeah.
I don't think servicing is an issue for investors. What I think though is people are accustomed to not look elsewhere, yeah, that could allow servicing to happen for them to grow their portfolio.
Yeah,
That's the issue.
I can tell you now firsthand. I've personally just gone through a refinance, and my wife actually works at one of the, well, up until very recently, worked at one of the big four, and even through the bank that we worked with, who we did do all of our lending through, we struggled to refinance there, or at least get an equity release for another. And by taking it to another bank, and we should have been able to get better lending at the one she worked at because we get discounted rates and things like that.
Yeah, of course.
Being an employee, we actually got a loan elsewhere so much easier just because their policies were better. And we have split ownership in some properties, and some lenders will allow you to use all of that income towards servicing, whereas others will give you 100% of the debt and only 50% of that income. So it's interesting, and I wholeheartedly agree that if you're working with a broker who understands the policy and your situation, they'll know where to take you.
Yeah, exactly. And again, it's just not uniform. I like servicing is interesting topic because you can go elsewhere and just find out, but we're just accustomed to do that. We see it everywhere. We hear it everywhere that there's only 3 or 4 banks that don't do so. So that's what we're just accustomed to. Like, let's be honest, like media, like um a lot of these banks pay heavy advertising dollars to media,
Yeah.
right? Like, are they going to say something, that's not going to favor them? Obviously not. It doesn't make sense. How are they getting advertising dollars in? But again, this is the relationship between us and Hotspotting to kind of, break everything apart and just make sure you get a true, current understanding of what that looks like. And again, 44% increase in property investors looking to sell, 50% offload within 6 months. You look at this and say, oh, okay, cool. Should I offload too? And again, it is wrong because, it's literally about understanding that it's just a change and shift in the market that people are offloading to then recycle their funds elsewhere.
Yeah.
And we are seeing interest rates, which has led to 20 to 30% rental prices. Here's another question, Tim. What do you think is going to happen? I've got a question for you. We're seeing 20, 30% of rental prices increase, right? But when rates start to decrease, and I'll talk about that in a second, but when rates start to decrease, what's your thoughts on rental price? Do you think it's going to hold a little bit? Do you think it's going to drop? What's your thoughts?
It's a really good question. I think the simple answer is this: if the interest rates and the rental prices were actually connected, then we shouldn't have seen property growth over the last couple of years. And this is what the economists were saying: interest rates are going to go up. We're going to see a demise of the property market, and we're going to go backwards. And there's been the big four have predicted in 2023 anywhere from 10% falls to 18% falls. And in fact, the national market in 2023 grew by 5.5%. So again, they got it wrong. But the point being that if there's far bigger influences on real estate than just interest rates. Right now, the drive up of rental prices, that's not in interest rate driven. It's lack of supply. It's increasing population. We're not building enough homes. These are all things that we don't have solutions for. So I still see that whilst I don't think we'll see the rental growth in the same at the same level as we have over the last 18 months, I think we'll still see significant growth this year, and then hopefully it sort of tapers off a little bit in years to come, in the years to follow, because it's actually, as much as it's great as an investor to have increase in rent, the social impact is huge.
Of course, no, 100%. And I want to touch based on that, and I think it makes. I think that if rates were to get cut this year, and if we're forecasting kind of mid to end of this year, I think rental prices still going to hold it because of the 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 lack of stock. Like the lack of stock is the one that's really driving these components. Anyways, we'll just keep going. And obviously, we've seen here, as you've said, mortgage cost of outpaced rental values. So Australian mortgage market predictions for 2024. Obviously, we've seen new inflation figures. Great. Well done, guys. Thank you for not spending. It's fantastic. Yeah, we're down from 5.4 in September, 4.1. I think it's a good inflation number, which I think is great. Hopefully, RBA sees that too. What does that actually mean? So hopefully, we're going to see a rate cut toward mid-year. I think I was predicting rate cuts to be early 2025, around about December. But if we keep this trajectory of inflation numbers, and hopefully RBA is listening now to the numbers and like what the economy is saying, hopefully we should see some rate softening, or at least holding kind of mid to third or fourth quarter this year.
Yeah. Just on that subject as well, Lucky, obviously there's what the RBA sets the cash rate at, which has obviously got an impact that flows onto the main lenders. But what's unusual in recent times that we've seen a lot of bank increases outside of cycle. Why is that? In fact, this week I think Macquarie even had a rate cut outside of cycle. So what do you put that down to?
Institutional funding is one. Like we don't just like institutional funding is another. The cost of employment is another. There's a bunch of random factors, but we have the good thing, and the first positive thing is, as a broker, what we tend to look at is the fixed rates. Variable rates, yeah, cool variable, but when lenders start cutting fixed rates, that basically means that they are forecasting already some form of cut or some form of hold happening already.
Yeah, it's
the
a
fact
future
that
indicator.
That's right. Like so, it was weird. Like when rates jumped a couple of times last year, banks already did that 6 months ago, right? So we already somehow predicted. They said, well, they're going to increase this. Let's just go. It's just they just got to be the finger on the pulse, versus RBA, which indicators are 3 months old. So like what we use as indicators, just to a nice little summary there is, if you start looking at fixed rates and you see some dropping of some lenders kind of dropping their fixed rates, we're expecting some movements on either hold or softening, hopefully very soon. And if you see fixed rate increase, then you're like something is about to go down. It may not be now, but the next kind of 3 to 6 months, it may go down. It may go up. So again, we're kind of seeing 2 years, hopefully some rate rise happening. Inflation, in rate cut. And again, we are seeing affordability issues and lower borrowing power, placing on the buyer's ability to purchase a home. This is more geared towards kind of owner-occupier, and hopefully we see some stabilization happening. Interest rate, again, you've just said it, which is great, Tim. You beat me to it, to be honest. We are seeing fixed rate cut as high as 0.56%. And we're kind of observing that. And my man, if I had hair and we see a fixed rate cut, I'd probably be dancing like this. So this is the stuff that we'd like to see. But yes, like just a little tip for everyone here. You see some fixed rate cuts, something is on the horizon, be pretty good. And again, we're going to see a stable, hopefully, market in 2024. Property predictions, we are seeing kind of flat on the higher end of the marketplace. We are seeing more affordable cities go in, which is like your Perth, parts of Brisbane, South Australia, so on and so forth. Reason why that is, it's actually very simple economics, right? If borrowing capacity for people is lower, you are tending to go to areas where the property market is affordable, and that's just what it is. It's just simple. If people could borrow $5 million tomorrow, they'd probably stay in parts of Sydney or parts of Brisbane or parts of Melbourne. But for the latter part of people that borrowing capacity is not there, you are going to see an influx. And we saw that when rates rose, when rates were rising in the last 2 years, our property business, we were like, I think South Australia is going to blow up. And everyone's like, nah, man, like South Australia, what are you talking about? Like, who's there? Like, 3 people. And we're like, no, it just made sense. Like, no one could borrow the amount that they could borrow. So we then over that 2 years, we saw, even as rate was increasing, the growth of South Australia, even the growth of WA now, which is nuts. So
Yeah.
those people that's obviously bought in, 2 years ago when they said, Lucky, you're crazy, is obviously making some coin now. And same thing, Tim, you probably support that too.
Yeah, absolutely. Just
Lending
on that
prediction.
subject as well, it's not
Tell me.
just investors there either. If
Mm,
you think about it, like I'll use Melbourne and Sydney as an example. If you go back to the start of 2023, we started to see prices softening in quite quickly. The second half of the year, we saw it pick back up and we ended up landing in positive territory. But if
of
we
course.
look at those, the start of the year where prices were going backwards, places like Adelaide were still, powering ahead, not just
Yeah.
because of investor interest. There wasn't hell of a lot of investors in the market at that time, but owner occupiers, if you think about it, if I'm sitting here in Melbourne, I'm a school teacher or a Sparky or something, and I got picked up and plonked down in Adelaide, I kept the same jobs. My interest rates are going to be exactly the same no matter where I live in Australia, but the median price of the houses that I'm living in and the income that I'm getting from my job are quite income similar, median price much lower. So what that means is with the borrowing capacity, I can afford to pay more for the properties that I want. So we see
Yeah.
owner occupiers driving those markets forward. And I can tell you from an advocacy side of things, chatting to the agents over there, the days on market in South Australia and Western Australia are next to nothing. I think the latest figures I saw in Western Australia, there was 7 to 10 days in some markets, which is just unheard of.
Yeah,
So
crazy.
you're 100% right. Like affordability is key while interest rates are high.
Yeah. Thank you. It's nice to be supported. Lending prediction. So this is now, really my forte. Let's kind of get into this. Buckle up. Let's go. So I think we're going to see some potential of loosening on the investment space. I really do. I think the goal of a bank is obviously to lend money out. That's the whole purpose of it, right? So warehouse funding, etc. I'm not going to go into institutional, but we're seeing that, and I'll tell you why we're seeing that now. So for example, ANZ, CBA, they're at 95% now. You could go 95% LVR on investment, not construction investment, but you can do 95%, which is again unheard of for a major. Like I can't remember the last time that they did 95%, even
Wow.
though banks like Teachers Mutual, and all us were doing kind of 95% for, as a non-bank for even the period, but they had strict servicing requirements, assessments, etc. For a major to then do so, they are kind of loosening up, and that's always a good thing.
That's a very
You can
promising
see
sign.
this. Yeah, yeah. Again, you can just see average rental yield here. A lot of people are focusing on yield. Yield's going to get you approved, right? Like a lot
Yeah.
of the guys that here are focusing on yield because they know for a fact for borrowing capacity, a lot more lenders are moving away from negative gearing and just focusing purely on dollar for dollar. At the end of it, can you make your expense? Can you make the repayments? This is the rental income.
Mhm.
And just so you know, here's another tip. Man, I wasn't even going to go to this, but man, I feel good today. Let's go. Some policies, right, with lenders. For example, let's say when you apply for a bank, let's for example say the rental is $550 a week, right? Now, that's a real life scenario. Let's say if a bank valuation goes there, yeah, and they on their valuation, I don't know, they had a terrible day that day, but the valuer goes, no, this is $450 a week because that's what it is, and obviously it affects borrowing, right? Because you're like, no, it's $550, I could prove that. Well, there's certain lenders here, there's certain lenders that we know, for example, that can take rental appraisals and not take the valuation number. That's a massive key,
Yeah.
right? Because if you're there and for example the lender's not taking actual and it's relying on say valuation, for example, becomes a problem for overall borrowing capacity. And there's a few lenders there that will verify rental income on actual and disregard rental income on valuation. Very, very important tip. Again, borrowers would like their product affordability. Um, Again, I said this at the start, borrowers seeking flexible options are going to turn to non-traditional lenders. Like Big Four is great. They have a purpose in the marketplace. It's good, but there's so much other people out there. There's so much other lenders out there that could make the assessment, especially if you're trying to grow your portfolio. Policy is going to be your best friend.
Yeah.
And I told my designer, I was just like, I want to show what the property market looks like today. And this is what the property market to me looks like. We're kind of the bulk of people, your barbecue mafia, they're just saying, oh, we got to get rid. We can't hold on. We can't hold on. But I think the horizon's very bright. To be honest, I think we just got to get over that hurdle, understand what it looks like, understand have really good people in your ear, professionals saying, no, you could actually do this. This is how you do it correctly and properly. And this is just a nice illustration to kind of do that.
Mm.
Now, best practices for obtaining finance in this economy. Let's break it down. And I'm going to be very, very controversial now. I'm going to go into it. Check your credit score. Everyone focuses on the credit score. That is not enough. Yeah, you can go to like the credit score is actually negotiable. So when we apply for a loan, we could check the credit score and we can negotiate with the lender and say, you know what, this is the reasoning why the credit score was low. What you need to focus on is your CCR, which is called comprehensive credit rating. So now there's open banking. They are every single time you have any liability, they have to lodge your repayments. It's what's called the credit character, right? I'm the bank. I've got to know that you are good for the money. That's what I want to know about, right? And this is important. So the zeros represent you paying, so you paid on time.
Yep.
The C represents it's closed. Now these numbers, your 3, your 2, your 2, your 3, if it's anything in the red, you need to fix that up. So important to understand, you have to look for these numbers, is because that means that basically you're in arrears by say 2 months or 3 months or 6 months or whatever the case may be. It will be red. This is what lenders judge you on. And
Am
some
I right?
lenders,
Lucky, is this something you can help people clean up as well?
yeah, 100%. We don't clean it up ourselves, but we have a lot of context
Oh.
in understanding that.
Mm.
And the reason why I'm saying be on top of this is because the banks can also get it wrong. Yeah, they may put 1 there. You submit it to obviously when it comes to us, we always question saying, oh, give us a reasoning why. But we've been in many instances where they paid on time, but it has been lodged wrong. This is so important.
Yeah.
So it's called CCR, comprehensive credit rating. Every liability is there that you've got in your name. Every single one. It's now an open, transparent view. Some banks don't even require bank statements anymore to provide your home loans, because they'll just see your CCR and be like, well, they paid it on time, you're good to go. That's literally what it is. They'll just look at the bank statement for a limit. But CCR, if you don't have this yet, best thing to do is just let us know. Obviously, we'll get it from you. It's free anyway, just Equifax report. And then you could see straight away, you could see directorships. If you've been put on directorships, you could see if you had any defaults, court judgments, etc. But CCR this is it.
I think
We've had
for everybody listening, I think there's something really important in there that I wanted to highlight, is that you may not be aware that you have been listed on here, not as a default necessarily, but the fact that you could have, something incorrectly placed on there. I know, you might be in an argument with a telco or a utilities bill where they've stuffed up, they've read the meter wrong, and you're arguing with them. That's still going to be listed on here to say that you've paid it late if you withheld payment. So I think it's a really good point for everybody to take note of, and they should be looking at that. You're right.
Yeah.
It's not just about the score.
Yeah, this affects you for sure. Obviously here, unlock and park equity, right? Like this is always I always say this to people with good valuations. Valuations is a bank opinion, or not even a bank opinion, a valuations opinion of your property.
It's an indication of risk for the bank.
Yeah, that's right. So, and that's why I'm just like, man, if like real market value is probably not there, but if you do have equity and you do want it to release and servicing is there, just park it in equity. You can open up another split, put the money interest only, put the money in there. You make 0 repayments. Tell the bank to just hold there and use it for a future investment use. Or you could, if for example, because principal and interest, you could borrow more than interest only. If the money was sitting in the offset account, it would just re-amortize itself anyway. So whilst there's equity, take it out, just park it. If, for example, you don't want to use it after say 12 or 15 months because something has changed, it's as simple as they close off that split.
Yeah.
But if an opportunity came, good to go.
Again, just going to jump in on that and talk about, there's a shameful, shameless plug for hotspotting, but we have a product called the Price Predictor Index, which basically allows us to analyze every suburb in Australia every quarter, and we actually judge sales volumes in the way of identifying whether a market's rising, falling, or whatever it may be. Now, through using that mechanism, whether it's for an investment location or where you are, if you identify locations that might be falling for a number of different reasons, if it's falling, taking out equity today is a way to safeguard that you've got that value. You put aside that cash, because the market drops, you can quite easily lose that. And that could be, in the tens of thousands or even hundreds of thousands of dollars. So it's
Yep.
a really wise move to constantly monitor that. And then you might have the ability to time it well and tap into some equity that you could potentially lose.
Sure. And I want to add now further, because in case people have like, oh, I don't want to take out more debt on the PPOR or the owner occupied. Well, there's a little tax rule here. Talk to your accountant, but there's a bit of here. So you can do a cash out underneath what's called investment use. That investment use is another split in the home loan. Obviously, if you use that money to buy the investment property, the interest may be tax deductible. Now, obviously, if you take out 100 grand for investment use and then you bought a beautiful car for 100 Gs, it's not tax deductible, obviously. But yeah, I didn't have to tell you guys that because you guys are hotspotting crew. And again, just get some pre-approvals. But pre-approvals, again, it only really lasts 30 days. I don't care who tells you it lasts for 6 months. It's 30 days. I'll tell you the reasoning why. Because on policy, they have to get brand new pay slips. They have to get brand new supporting documentation to support that. So if you want to get real pre-approval or just at least some indication, the best way to do is speak to a broker, speak to us. We'll do the numbers and make sure we'll tell you where the comfortability lies in. So just a heads up on anything else. And again, shop around for lenders, but stop shopping around for rates. Rates to an extent is great. And rates to an extent is fantastic. Owner occupied, I get it. Like I actually do get it. Like you want to get, rate shopping, no problems. Investor has to look for the best policies. What's the best way that I could utilize the current securities that I have, the current incomes that I have, to then look for the best deal that can help me grow my portfolio without affecting my lifestyle or the initial plan that I had. And this is where I always educate investors and be like, look for policies, stop looking for investors, stop looking for rates. And obviously avoid just making, massive purchases on that. The biggest one here is car loans we're seeing. That's usually affecting servicing and kind of anything external on that. Just FYI, then just more as a tip, car loans and personal loans, what the lender really cares about is the repayment, not really the limit, right? The repayment. I'll give you an example. If you've got a Suzuki Swift and the nothing wrong with the Suzuki Swift, I just used it in my head. $5,000, let's say you owe $5,000 on that. The repayments is $1,000 a month, even though it's going to be paid in 5 months, $1,000 a month. And you've got a Mercedes, 100 grand car, but the repayments is $200 a month. Yeah, your borrowing capacity is actually better with the Mercedes because it's based on the repayments per month. That's usually what it calculates for it. Whereas with lending and home loans are based on the limit, everything else.
So is car lending something that you work with as well, Lucky? Because obviously, a lot of people put their cars onto their mortgages for obvious reasons, but do you do asset finance as well?
Correct. Yeah, we're actually now in negotiation to acquire an asset finance. Man, so much plugs today, Tim. Man, I sell DVDs too. No, jokes. No, just jokes. We are going to. We're actually acquiring now because we do have a lot of self-employed clients that want to, obviously buy multiple asset finance stuff for trucks and cars. And yes, we do that now underneath Finance Better, the brand, but we are going to separate it so that way Finance Better focuses home loans, then Loan Garage. Look out for it, guys. Will be for the car loans and asset finance.
Amazing, very good.
And the last one here is work with a mortgage broker, right? I don't know about you, but there's one brown Asian cute guy that you could work with. Yeah. So if you want to work with us, happy to. If you want to work with your current broker and you want us to review it, I'm still happy to. Like, we like the industry, we love what we do. We work with other brokers. And if, for example, you want a second opinion, even though you want to use your previous broker, no problems. I'm happy to help. No, wherever you can. Just say that obviously you guys came from Hotspotting. I'm happy to drop everything to help out where I can.
Amazing.
Obviously prepared to provide documentation when you need to. Now, insight on self-employed and SMSF loan markets. Self-employed, we know, has been is a bit growing over the years. Get a better accountant, please. I can't stress that. Most self-employed that's trying to go for it, accountant's role provides one thing, and usually accountants and brokers or banks are fed up with each other, right? So get a better accountant that's going to help you. That's going to help you with lending. That's going to help you understand lending parameters, and that's the big thing here. Next one is
quickly on that as well. It's one of those things. Don't leave it until the end of the year to speak to your accountant, and then all of a sudden you've got your tax return, and you go to and you notice of assessment. You take it to your mortgage broker, and the broker says, "What do you want me to do with this? You didn't make any money last year." The accountant might have done his job. You didn't pay a heap of tax, but it's going to be hard to get any loans. So having a strategic conversation with a broker and then having them liaise with your accountant so he can actually plan and tax planning so that you can actually get loans is a really important factor. So you shouldn't be seeing your accountant once a year. You really should be planning more regularly with them.
Yeah, 100%. Next one here is obviously low doc is almost the same as full doc, but there's low doc, mid doc, full doc. As rates are where we are at the moment, I remember when interest rates was like 2%, 2.5%, 1.99 actually. We did a couple of fixes at 1.99, and low doc and mid doc was at like 7%. So self-employed had a big disparity between getting lending, but now we're kind of seeing full doc rates at that kind of 5s, 6s, and then we're seeing early 5s and 6s, and we're seeing low doc and mid doc at that kind of 7ish. So it's actually, we're not, the disparity between low doc and full doc is actually not that that's insane anymore. Now this is a personal opinion. Yeah, this is just personal opinion. If you have a sole trader company, the reason why I'm saying that, obviously check with your accountant if it's ideal for you first. In proprietary limited scenarios or PTY LTD, it's actually better for lending versus sole trader. The recourse of liabilities is you, whereas in company, the recourse of liabilities is in the company. And you could kind of pay a director's wage that could be used as income for it. And so that, whereas sole trader, it's just you.
And does that change? I know some lenders want to see 2 years worth of
No.
lending on an ABN. Doesn't change?
No. So some lenders now are willing to just do drafts. Majors are doing drafts. You don't have to do tax returns. You just have to be notice of assessments. Not NOAs. Just literally draft. Yeah, accountant letter saying this is what we're going to lodge, but draft. Literally, it draft. Wow. Right, which is insane. And again, we're talking about SMSFs here and the opportunity within SMSFs. And how popular are they? There's 610,000. So there's a lot. There's $878 billion worth of self-managed being traded. We're seeing that being opening. There's 610 to 87 today, and that's growing because a lot more people want to take advantage of the SMSF. And if your lending capacity is maxed outside, SMSF will be brand new. So for example, you're like, I really want to start growing, but I want to control it. No problem. The SMSF will just do that by itself, and I think that's great. Because we've got a couple of clients, they like, oh, we want to keep investing, but we're maxed out outside. They'll go into SMSF and they're like, oh, what's this? They won't take any lending outside, which is great.
So with again, what sort of rates are we seeing there, Lucky? Just an average?
Early sevens.
Early sevens.
Early sevens.
Yeah,
so we're seeing
can I ask you, there probably is people on the webinar today that might have existing loans. Being the fact that self-managed super funds are commercial loan, one of the hesitations for a lot of people in the past has been a refinance is quite expensive. What sort of application fees are you seeing in that space now? We
usually pay for application fees. So depending on who you got, like obviously from Hotspotting, we're happy to do that. Yeah, we're happy to refinance anyone from if you've got existing lending with your majors or some non-bank lenders that we usually higher rates. I've had one like 9 and 10%. We could refinance that, and then we could talk about the fees on that. But usually it's just the valuation, and then your basic setup fees. So depending which lender you go to, obviously we could break it down depending on who you speak to.
Terrific.
And again, we're seeing a growth in SMSF now moving. Now, this is important. Not a lot of SMSF lenders, a lot of the SMSF lenders have moved out of the marketplace, but you're seeing 1 to 3 lenders really go back and going hard in it. So now we're actually seeing 90% LVR. On SMSF.
I've never seen that.
Yeah. It's usually they max it at 80%, but one lender in specific has gone to 90%. Instead of charging LMI, there is a risk fee. So I'm not gonna. There's a risk fee that is like the LMI, right?
Yeah. Okay.
But they are going up to 100%.
Typically, maybe for your first time getting into the loan as well, you probably find that you get some 90%. But from a refinance perspective, most of them are going to be well under that anyway.
60s, yes. Like refinance, like 60, 65, 70%. And as you guys know, when you refinance an SMSF loan, it's dollar for dollar. You can't release equity in SMSF. Yeah, the debt then crystallizes. So if the first loan is 300,000, non-recourse, it has to crystallize, and you can't play equity. If you want to do that, you have to sell the security, so on and so forth. Now, solution. At the end of this is how people feel right now, man. This when I was making this PowerPoint presentation, I was just like, man, at the end of this is how I kind of feel. But there should be a better way to do things, and the reasoning why we're here kind of today. What do you see here, Tim?
Well, I see 2 things. Depends what it's in relation.
What's the first thing that you see?
I see a duck first. And a
duck first. Cool. I see a rabbit first and a duck second.
Yeah.
This is an important understanding of what the market looks like. What does an opportunity look like for you? And that's the truth. Like, do you see certain places be a duck, or do you see certain places being a rabbit? Like, what does the opportunity look like? How does that then translate into your overall portfolio growth?
Mm.
Now, let me ask you questions. You obviously have two choices here at the end. Do nothing, understand what that looks like, or just talk to us and see what else is there better to do. So what we're trying to understand here is, and this is for all hotspotting group, even the people here in the webinar, you have a clear plan, understand what that looks like. We'll do evaluation on your property, on your properties. They're all free, by the way, just so we can understand that. And this is a little plug for us. Tim is anal. He's like, we interviewed, I reckon, for 12 months for it. And at the end of it, he was just like, you got the best interest for the clients. And we really wanted you part of the panel. And we were really excited to work with him, and we share the same love and DNA that Hotspotting and his crew does. So yes, we will do bank valuations. We'll do review structures. You don't even have to refinance. We're happy to even review it, even if you're in the same lender. I'll just call them up and negotiate the lender for the rate for you. And again, a couple of results here. This is a nurse. I'll just go through it. This is a nurse. Didn't know what the opportunities were. We found SMSF. She actually paid off a home loan. We looked at. She bought a capital growth security, sold that. Obviously, paid it down. And a mechanic and teacher, like we really do try to find opportunities for it, and you don't have to be, mega for it. Like it doesn't need to be that. Like people in unique and wonderful situations is what we do. We try to realize. So there's details there. You could type in Instagram. You could find me on Instagram and see what me and my family does. And then obviously, if you want, there's a link to be sent out. But you could scan this link and you could click it. Just a little type form, name and number. Happy to help. And yeah, happy to help where I can. And that is moi. Thank you.
Thank you very much, Lucky.
You're
Very
welcome,
good.
my man.
Well, yeah, look, I think there's plenty of takeaways in there. I think it's an interesting landscape, the mortgages for 2024. But a couple of takeaways for me today is, really, you don't know what opportunities are out there until you have those conversations with someone like yourself. I think given that we've seen such high interest rate rises and we haven't seen rates come back yet, you could forgive some people for not wanting to entertain a refinance because they might feel like they're going into a higher rate. But I always think that, depending on what your goals are, the policies that other lenders might open up, even if the rates are on par, could allow you to do things you may not have known you could do. So if you see that there's opportunities on the horizon for 2024 to expand your portfolio, by all means, recommend getting in touch with Lucky and his team. Now, obviously, this brings us to question time, Lucky. So you still got a bit of voice left?
Man, I'm whatever. Let's go. I'm down. Let's go. I know you got some questions too. Yep. So I'm open for whatever. No problems at all.
Okay. Yeah, look, I've got a couple of questions in there in relation to self-employed clients, whether or not there are lenders out there that will do less than 2 years. And by the sounds of things, you do?
Yep. Yeah, correct. So the biggest thing here is so let's talk about full doc. Full doc, yes. If you're like they look at the ABN, so it's a fresh ABN. To be honest with you, there's probably 1 or 2 lenders, but it's not going to be full doc. It'll probably be a low doc or a mid doc. They could consider 1-day ABNs, but you need to have historical of what it is. So you are a plumber for PAYG, you went into ABN, that kind of makes some sense. We can justify it. If, for example, you want to go down full doc component, as long as your accountant is good and understands what that looks like, and yes, the money's there, then you could go down ITRs, draft ITRs, by the way, which is again insane. Yeah, like draft. So draft supplied by an accountant's letter. But yeah, the biggest one is ABN, the longevity of the ABN. So if your ABN is less than 3 months, 4 months, most likely there is options, but it's going to be, a mid-tier lender, non-bank lender. But if you're is more than 14 months, 16 months, then you should be able to go to a full doc lender, no problems at all. And that's majors, by the way.
Okay. There's another question here from Sally in relation to applying for loans using a family trust. That'd be treated very similar to a self-employed, I imagine.
Yeah, correct. Family trust is an important one because they talk about it depends on the beneficiaries of the family trust. But yes, it's treated normally as a self-employed loan. There is at times, if for example you are a beneficiary of a family trust and you do get dividends from the family trust and the person wants to apply as a beneficiary, we could use that income in its own entitlement as well. Just do note though, just make sure that you are going to a lender that understands how to use family trust and what you're trying to do. But yes, very, very similar to how normal self-employed is done.
Okay. Very good. Karen's asked whether or not you would be recommending any fixed rates at the moment, or whether you're leaning towards.
Oh,
Tough one.
who asked that question?
Karen.
Man, Karen, I love it. That's fantastic. Personal opinion, yeah. I don't think far out. Here we go.
I think it's got to come down to the scenario anyway. Like
yeah, look, it is like straight away. I think there's multiple scenarios here. I think overall, like what I'm doing my stuff with my lending and loans and properties is I'm not fixing anything at the moment. I'm just kind of holding still and then seeing that, unless there was something great that came on. If I was to fix, just because some people do want the certainty of fix, that's no problems. I'd probably fix for say a year. That's a good time to say fix. Yeah, 12 months is good. You could kind of readjust and see what's happening in the marketplace, then kind of roll it over for say 2 or 3 years. I think the last thing that we want to be doing is fixing it for say 2, 3, 4 years, and then something happens and you're going to pay all these massive fees to exit it just to get a cheaper rate.
That's a really good point. I think yeah, we can be attracted, and I don't think there's a lot of really exciting fixed rates out there at the moment anyway.
Nah.
But you know, the one thing we've got to consider with anything fixed is that it also comes with restrictions that which would can force you to pay big break fees and things. So that's something you need to consider.
Yeah.
It's not just about the fancy rate.
I'm gonna add that as well. Yeah, talk about fixed rate, especially if you have an interest-only investor, right?
Yeah.
Yeah, and you want some certainty and you're comfortable with the repayments and you want to do that, yes. And the reason why I'm saying it's okay to fix interest-only investor loans at this time, if you wanted to, is because interest only is a credit critical factor. Yeah, I'll repeat that again. Interest only is a credit critical factor. If you have a principal and interest loan, to change it into interest only, you've got to provide documentation because you're extending the term. You're reapplying for credit, right? Now, if, for example, let's say your interest only finishes and something happens with employment or whatever the case is, and you're trying to roll over the interest only, it's not going to happen. So then you're going to go back to P&I. It's going to throw off the borrowing. It will throw off your repayments. So if you want some certainty regarding interest only and you're comfortable with the repayments underneath the investment, you know, your tax or whatever the case may be, then it would be a suggestion to do so. Because I've got a few clients now, they're like, I want to roll over. I'm like, you can't.
Yeah.
So that's what's happening at the moment.
Okay. Got a question from Madison. Is a complying regulated superannuation fund an example of a self-managed super fund?
Yeah, I'll answer that from a compliance point of view because I'm not a financial planner. But it's, to my understanding, it's not, because a compliance superannuation fund is that of an industry fund. An SMSF basically is you open up you had to open it up. You speak probably to a financial planner. We have a few here, and then they advise whether it's right for you. Of which then, if it is right for you, you move your industry fund money into the super fund, so then you could invest yourself, of which you could invest in shares and you could invest in property, whatever the case may be. Now, this is a big statement, and I'm going to just put it out there on Facebook. I don't know the codes in Facebook. You're going to get a ton of property ads after this. I just know it. Yeah. So I just scroll Facebook. You're going to get a ton of property ads. I'm sure you guys see it saying you can buy property in SMSF. Just please be careful with that. Just because the last thing that you want to be doing is getting an ATO call saying, hey, you know, where did you find this? How did you then do this? It would be a pretty yucky conversation to kind of have, and it's probably pretty intimidating. So the best way to then do it, make sure it's okay. Speak to a financial planner. The cost of a financial planner to advise you, and I'll tell you what it costs, depending on what it is, it costs anything from 1 to 3K. That's what it is. That could be taken from your super fund, but that's usually the cost for it. And I just want to be open and transparent in that.
Yeah. Question from Jay: are you able to review property performance portfolio to see what opportunities I can seize moving forward?
The answer to that is both yes and yes. So the first one is performances. Like, I think it's nice to also get bank valuations. Like, bank valuations will tell us really what it is, because you probably could be performing aggressively well, but at the same time though, does the bank also see it that way? And if the bank sees it that way, that's good. So we can release some equity and then see what that looks like. If we do, usually what we do to check out performances is using Hotspotting and the software with them. We'll use a bank valuation, maybe compare that towards the last couple of data, and then look at the cash flow on that property, and then just kind of see if it's worthwhile holding And again, but then we still have to talk about your tax movements, your what you want to do, if it's cash flow, if it's capital growth, etc., etc. But for anyone that has properties now, we're happy to do valuations on it. We're happy to do multiple valuations on the same property. It costs nothing. I'm going to be honest, yeah, it costs nothing to do a valuation, just straight up. So as long as we do it properly, there's some lenders that are a bit more lenient with valuations. We're happy to order that from you, and you guys can keep that on file, give that to your accountant, no problems at all.
Amazing. Well, Lucky, I think we've got one more question to follow up from Jay. Are there any age limitations? I'm only in my 50s and still want to invest.
I love it. What's his name? Jay.
Jay.
Nice to meet you, Jay. We did a loan for we did a loan for someone that was in his 70s. And it was a 30-year limit investment. Anything one with age, right? Like the bank sees kind of like 50s as age. Investment properties are actually very good. You always get a 30-year term. As long as we can show that you're an avid investor, that there is some super.
There's got to be an exit strategy.
It's just an exit strategy.
Yeah.
And the exit strategy is as simple as, if we can't afford the repayments, we could then sell the property. And what they care about actually is where you're going to live. They have that responsibility. So if you already have a paid off PPOR, if, for example, you have family, if, for example, you understand where you're going to live after, no problems. Yeah, we've do that multiple times over and over again.
Amazing. Well, Lucky, that was fantastic. Really enjoyed your presentation. I've got a couple of
appreciate
out along the way. I learned a bit, and yeah, it was really enjoyable. So I hope you enjoyed yourself as well. Thank you so much for your time. Let's do it again soon. And as I mentioned, and as Lucky offered, please feel free to reach out to Lucky, www.financebetter.com.au. And we look forward to seeing you all again soon. Thanks so much.
See you guys. Bye, everyone.
Bye.
See you guys.